Hello, my friend. Welcome to Charlie Retail Invest. Let's track the latest trend in US economy and share our recent investment in stock and bond markets. Today is Monday, August 25th, California time. Just last Friday, on August 22nd, Federal Reserve Chairman Powell delivered a blockbuster speech at the Jackson Hole Economic Symposium in Wyoming. His remarks directly triggered an explosive surge in the US stock market, not only in major economies but around the world as well. It could be argued that Powell's announcement of an interest rate cut laid the foundation for a sustained bull market in the US stock market for the second half of 2025 and well into 2026. In his speech, Powell stressed that although inflation risk still exists, the US labor market and economic growth has a significant slowdown, and this is the major concern of the Federal Reserve right now. And this is consistent with my own investment assessment of the fundamentals in the US economy in my previous video on July 21st and August 20th. Mr. Powell also said that the Fed may be more inclined to pursue its dual mandate of maximum employment and price stability, and he will pay special attention to the health of the job market right now. And it also has implemented a change to going away from the average inflation targeting to a more flexible inflation target. This means that Mr. Powell will no longer emphasize keeping the US inflation rate under control by around 2%, but it will instead flexibly adjust the inflation rate based on actual economic conditions. As long as inflation doesn't spiral out of control like it did in 2020 and 2021, the Federal Reserve could tolerate an inflation rate above 2% for an extended period of time, for example, around 2.5% to 3%. In other words, the Federal Reserve has confirmed that it will resume its pace of interest rate cuts after the FOMC meeting on September 16th. We are likely to see the benchmark interest rate steadily decline from the current 4.25% to 4.5% to a range of 3% to 3.5% by the end of this year. And a lower interest rate environment is definitely beneficial to the US economy and to small and medium-sized businesses. I'm fully supportive of Powell's decision to cut interest rate. And I hope that following the Federal Reserve rating cut, more companies will begin hiring again, and that those who are seeking for jobs will find satisfying, ideal employment for their family. There is no doubt that once interest rate cuts begin, not only will they benefit the US economy, but they will also be a very good booster for the US stock market. So following Powell's Friday speech, the S&P 500 resumed its upward trend, reaching new all-time highs. At the close of trading on August 22nd, the S&P 500 reached 6,466 points, just a shy of its previous high of 6,480 points. Based on the latest data, my AI investment system has released a new forecast for the US stock market. It has abandoned its previous prediction of a buying dip point below 6,180 points, and now the system recommends buying the S&P 500 with confidence if it experiences a small pullback in the coming weeks. This is because the AI system predicts that the S&P 500 index will likely close between 6,800 and 7,000 points by the end of 2025, which is up from its current level of 6,466 points. This means that even if the S&P 500 experiences a brief correction in the coming months, we will still have a net return of 5.1% to 8% that is higher than the current price by the end of December 2025. Therefore, I also have given up my previous waiting strategy and become much more aggressive in buying US stocks and increasing my stock positions. Of course, there is no doubt that we are now definitely near the high point of a bull market peak. The current situation is fundamentally different from the short-lived bear market caused by Trump's tariff war in the early April of this year. From the latest stock holdings of institutional and retail investors, we can see that as of August 22nd, the stock holding ratio of institutional investors has reached a high of 95%, which is even higher than the 77% level in January 2022 and 87% level in February of 2025, which were both the top of the previous US stock bull market. And retail investors' current stock holdings are slightly lower at only 80%, which is actually lower than 92% back in January 2022 and 85% in mid-February of 2025. This suggests that in the coming months, retail investors who have not yet onboarded with the stock market will continue to buy the dip and buy into US stocks, further pushing the S&P 500 and Nasdaq 100 indices to all new-time highs. Furthermore, as US tariffs gradually stabilize, the S&P 500's EPS, which is earnings to price ratio, will continue to rise. We are likely to see that the S&P 500's EPS ratio relative to its one-year forward EPS rise from its current level of 91% to a high of 97% that was achieved back in mid-February. If the S&P 500 maintains its current PE ratio of 27, its price will be 6.6% higher by the year end. Therefore, I'm very optimistic about the performance of SPLG, QQQM, and SPMO in the next 3 months, and I recommend that everyone consider buying the dip. However, while the US stock index is likely to continue reaching all new-time highs, sector rotation within the stock market is quite quietly underway. From April to August, the best performing stocks in the S&P 500 and Nasdaq 100 indexes have generally been semiconductor stocks that are closely related to AI, or AI tech companies, or cryptocurrencies and financial stocks. And in sectors like pharmaceuticals and oil and energy, most stocks have fallen badly. However, I recently have discovered that starting from the end of July to the beginning of August, the ratio of traditional value stocks relative to technology growth stocks have actually begun to bottom out and rebound. We can see that the ratio of value stocks to growth stocks in the figure has been declining since December 2022. However, just 3 weeks ago, this ratio began to show signs of rebounding. While this ratio is still very low right now, we may see stronger gains in value stocks compared to tech stocks over the next 2 to 3 months. After all, stocks like United Healthcare, Eli Lilly, ExxonMobil, Procter & Gamble, and Johnson & Johnson all have very low bases, so their gains over the next period of time are likely to be higher than those of stocks like AMD, Palantir, and Robinhood. Therefore, based on these new data, my AI investment system gave a new stock, gold, and Bitcoin holding ratio allocation as of August 25th. The AI system recommends reducing the ratio of ultra-short treasury bonds or cash from 15% to 0, and using the money to invest in US stock indices or individual stocks with growth potential. We can increase the stock allocation to 75% of the entire portfolio by buying the S&P 500 Momentum Index ETF SPMO at $114.8 or lower, the S&P 500 Index SPLG at $74.8 or below, the Nasdaq 100 Index ETF QQQM at $233.5 and below, and the technology sector index ETF VGT at below $680 per share. Of course, I believe that in the next few months, VGT's performance might be a little bit worse than other comprehensive indexes such as SPMO, SPLG, and QQM. So you may want to prefer to buy those more comprehensive indices. And at the individual stock level, the system recommends buying the dip in Lululemon at or below $205 per share, buying TTD at around $53 per share, and buying HIMS below $45 per share. All these 3 stocks are relatively cheap and have recently shown signs of rebounding. So risk-averse investors may consider buying low holding for 2 or 3 months of these stocks and then selling them at high prices to lock in profits, creating short to medium term investment opportunities. As for the proportion of gold ETFs, the system recommends holding a 15% position in gold. You can buy IAUM at $33.1 or below, buy GLDM at or below $65.8, and buy GOD at or below $305. The Bitcoin holdings remain unchanged at 10% of the entire portfolio. You can consider buying IBIT below $63.7 or buying FBTC below $98.6. Overall, CRI's investment recommendations are nearly fully invested. We are maximizing our aggressiveness to maximize returns in this bull market run that may last another year. In the current environment, we shouldn't overtime the market and holding short positions or cash and waiting for the stock market crash to happen. Doing so will only increase the risk of being missing out. Instead, I recommend holding on to your investment in stocks, gold, and Bitcoin, and patiently wait for this bull market to continue to push up your asset prices. And there's absolutely no need to worry about the risk of a brief market correction or temporary falling stock prices. Don't let Wall Street's market crashing tactics scare you into exiting the market early and missing out the opportunity to make more money in this bull market. This week will represent a very good entry point opportunity as Nvidia, the world's largest tech giant, will release its second quarter earnings report on August 27th. We are likely to see some investors take profits at high levels, selling off Nvidia and other previously high-performing tech stocks. Because the market is quite worried that although chip companies such as Nvidia and AMD have very good sales numbers of GPU and AI chips in 2025, the vast majority of these purchases will be concentrated in other tech giants such as Microsoft, Google, and Meta. So if these major tech companies have reached their recent procurement targets, then Nvidia's chip sales won't be able to maintain rapid growth in the coming quarters, and its financial performance may not be as impressive as it is now. This will put Nvidia's stock price at a significant risk of a correction, and it will cause a small correction in the US overall stock market, giving retail investors who haven't yet gotten on board a chance to buy in the dip. So please consider this when the time comes. Of course, the future is full of uncertainty. If there's a real risk of the US stock market turning from bullish to bearish, such as a real recession, then my AI investment system will provide immediate warnings. We can then reduce our holdings and sell stocks at a much higher level, taking profit and exiting at high prices. Please consider subscribing to Charlie Retail Investment channel so that you won't miss these latest US stock investment updates. This is the latest holdings of CRI's investment portfolio as of today, August 25th. We've sold all of our Google positions last Friday when Google's stock price hit a new all-time high, locking in a 20% short-term capital gain, and used the money to buy TTD, Lululemon, and FICO stocks on dips. And currently, Eli Lilly is our largest holding, accounting for 28.6% of our entire portfolio. AMD comes next, accounting for 19.7% of our portfolio. And the third place is the two times leveraged Lilly ETF, LLYX, which accounts for 9.6% of our total holdings. Amazon stock ranked fourth, accounting for 9.3% of the total position. And the fifth place was the Bitcoin ETF IBIT, which accounted for 6.6% of the total funds. And ranked 6th through 8th are TTD, Lululemon, and the Defense and Aerospace ETF XAR, each holding over 4%. Finally, Apple and FICO each hold approximately 3.3% of the entire portfolio. As of the last trading day, August 22nd, the CRI portfolio had a return of 12.7% in 2025, which is actually higher than the S&P 500's 10.9% return. We hope that our investment portfolio will perform even better in the coming weeks. and I will continue to bring you more updates, and I hope you can support me. And that's the whole story of today's video. If you are a retail investor like myself and would like to follow our highly effective AI investment system to make a ton of money and become financially independent, please subscribe to our channel, Charlie Retail Invest. Thank you so much for your time and support. I'll see you in the next video. Please take care.